So today I wanted to go over some numbers with you guys and just show you a bit about some of the logic in the property investment side of things and why the numbers are so important, and also just how the numbers can work and how they can be really in your favor, and also how they can be against you. Just the simple things that you do can make a big difference in property investing. And the tricky thing about property investing is that, buying a property is not an easy process in a lot of cases. You've got to go through bank loans and take time to do it. And once you get it, it's certainly not something you can sell the next day. You're going to have to have that property for a number of years. And if you do want to get out of it, it can be problematic if it's the wrong property. So that's why it's very important to make that right decision based on your numbers and your lifestyle. And hopefully tonight, you could get a bit of an idea on what might suit you and just some of the numbers and how they work. I've taken a very generic approach tonight to try and give you a bit of a cover of a few different styles of property and different types of property and what they do and what they can do for people. I won't go into too much depth for personal side of things for people, but generally, that's something that we can certainly help you with on an individual basis. So I'll start with the presentation and we'll go through just some of the basics there for you. So as I said before, we design numbers-based property solutions. So we don't sell property like a real estate agent does. Our job is to focus on the numbers, and the numbers don't lie. The numbers tell us a story. The numbers tell us what we need to be looking at doing, because that's the most important part. We have access to property and builders Australia-wide, so we're not sentimental. We don't just deal in a certain suburb or city or area. We don't have a favourite area based on that we'd like to holiday there. It's based on where can we go in Australia that's going to have potential to make good capital growth for people and also some good returns on income so that we can have good cash flow. As I said before, we have 27 years experience in the investment property and finance side of things. From our finance side of the business, we have access to over 40 lenders. You can certainly benefit from our numerous long-term relationships with the conveyancers and solicitors and accountants like Gary. Gary's my own accountant. So, that's why we work closely together. And I guess we've got a similar mindset to property and investing. And I refer a lot of our clients who purchase through us to Gary because he has some great knowledge around trusts and planning and just general tax needs. So certainly this is sort of support you need when you're looking to buy something. You need the people around you and that network to be able to help you. And that's a really big thing to have that network. Exclusive property management team for co-living and NDIS STA properties. So we have our own property management business that looks after our own specialised products. And to be honest, that means we've got skin in the game. That means that we're not going to just, provide you with a property that you're going to get stuck with then trying to get a tenant from somebody else. We have to manage that property that we're also selling you. So at the end of the day, if we don't give you the right property in the right area, then we're going to be in trouble as well, because our businesses aren't going to make any money because we're not going to be getting any tenants for you. So we do our best to provide those properties in the right areas, the right levels, right locations, so that we can get those tenants as well. So I think that's a big advantage over a lot of other companies out there who may just sell property rather than actually journeying with their investors. So we like to think that we journey with our investors. Our approach at the Property Investment Store revolves around designing strategies, as I said, that are customized to your unique financial situation. So no two people are the same. Generally people have different needs and requirements, different age brackets, different stages of life. And we want to design property strategies that really suit where you're at and what you're looking to do in the future. We're not a real estate agency. Okay, so we don't just sell property to people. We don't just take orders. We don't engage in property sales, as I said, but instead offer a bespoke property solution to help you achieve your specific property goals. So that's in summary what we do. So when we move to, I guess, our structure and how we like to look at it with our investors, we like to find your purpose and what your goal is. What's your why? Why do you want to invest in property? What's the reason behind it? What do you think you're going to get out of it? What are you looking to get out of it? What do you want to get out of it? You know, we want to find your purpose. Then we bring in our strategy. Once we've found your purpose, we design our strategy that we believe is going to suit what you need to create and to resolve your purpose. And then we bring you the solution and we say, look, here's a solution we believe is going to enable you to achieve what your purpose is, your individual purpose. And, you know, we have a very structured process in how we operate with that because, as I said before, it's about the numbers. So we like to let the numbers guide us and numbers lead us. And another thing we like to do is make sure we educate everybody. I mean, my job really and our job here is to educate the fear out of people. You know, we want to teach you and empower you so you have the knowledge and you don't feel concerned or worried about you know, what's going on because you're being educated all the way along. And the more empowered and the more knowledgeable you are with the process, the more comfortable you're going to be because you understand it. A lot of people just try and sell product to people. They're just trying to sell it rather than explain it and guide people. And that's very problematic. So I think generally this structure is one about really getting to know you and providing something that you actually need.
And Anthony,
sorry.
For a second.
Go on, Gary.
And I think it's, you know, I look at this and go, each client that I work with has a different requirement for an investment property or has a different requirements for buying properties. And this is where we want to have, you know, a diverse range of strategies that will be best used for each person. So we don't want one hat that fits all. When we go to a real estate agent, that type of person, you're looking at all the properties in a suburb, but that suburb might not be a good suburb. So we want to be looking at what's out there, what's different, what's the right investment property for you and your needs so that we can tailor something special for you. You can continue. Sorry, Anthony.
That's all right. No, it's true. And I think that's the key. You know, real estate agents, they know their suburb and whatever the best investment for you is whatever's in their window. They're not looking at it as in what suits your numbers and your needs. One thing that we're really passionate about, especially at the moment, because I think everyone's fairly passionate about it as well, is people's mortgages. Most people are suffering with a mortgage increase rise at the moment, and it's becoming a little painful. And it's something that we certainly don't like. I don't like seeing banks make money. I don't like seeing the tax department make money. And my job is to work with Gary and yourself to come up with strategies that are really going to be able to help you in all those areas. I don't call your home loan your mortgage. I refer to it as your financial cancer. Okay, cancer is a horrible disease. There's no doubt about it, and you know it really robs people of the quality of their life, and it can also take people's lives. And I don't call it financial cancer lightly, because in all the years I've been doing this, all I've seen home mortgages generally do to most mums and dads and people out there is strip them of their lives. And if I look at the statistics that I've actually come up with myself from 27 years of doing this, is that most 55-year-olds that I see still owe about 1/3 of the value of their home, no matter where they live. So when it comes down to it, have a think about your value of your home, have a think about your mortgage, and have a think about your age, and project yourself wherever age you are. If you're 55, should be easy to figure out. If you're 40, project yourself and have a look. Most people I see still owe 1/3 of the value. Now, that's a real problem, because if you've got 5 to 10 years before you want to retire and you still owe 1/3 of the value of your mortgage, you ain't going to be retiring. And as far as I'm concerned, we need to cure people's financial cancer before we worry about retirement planning, because this is a big problem. This mortgage bit is a major stick in your spokes. It's the thing that's going to hurt you the most, and I can go into far greater detail. And I've written an ebook on it. If you want to download on the ebook, you're welcome to download that. I can give you a link. But definitely, we need to see that cured. We need to see that gone. And I believe that through property investing, you can do that very, very well, and very, very effectively, and very, very cost effectively. So I want to go through some numbers and give you a bit of an idea, but let me just pose a question, right? and this is a pretty simple one. This is nothing like no one's going to get any prizes for it, but what it comes down to is, what if you could make $300,000 over the next 5 years and it costs you nothing to do it? And it's totally legal. I'll just put that in there. Okay.
Yeah, how good would that be? I love this. Let's sign me up.
Well, this is it, right? I mean, people say to me, oh, this sounds like a sales pitch. This sounds all, salesy. But let's remember, this is about the numbers. It's not about sales. It's about fact. Okay, I've got to prove to you that this fact is correct. Right? I'm going to prove to you it works. So just remember this saying, right, as we move forward now. So 300 grand over the next 5 years, and it costs you nothing out of your pocket to do it. Huh? So that'd be pretty cool if you could. So let me show you how I believe you can do it. Now, I've got some numbers here, okay? There's a lot of numbers, but I've highlighted stuff that matters, and I'll go through it very simply. I've got 3 example properties here. This is a program called PIA. It's a property analysis software that is fairly much an industry standard. It's pretty much what Gary does when he does all these calculations at the end of the year to work out what your tax benefits are on property and all sort of stuff. But it's a fancy little program that
all the time I use it.
Yeah, well, Gary uses it all the time, right? Because it's a pretty much an industry standard program. But the idea is I want to show you some key points in this. And I've used three property examples, but funnily enough, they're all the same property price. Okay, so let's pretend we're going to look at 3 different options of property. So this first example I'm using here is, mum and dad, they go out, they want to buy an investment property, and they want to buy a property that is, the property value is $812,000. Okay, so that's the value of the property, brand new property, $812,000. In this standard property example, it might be a 4-bedroom house and land package. They're going to rent that out to mum and dad and a couple of kids, whatever. And they're going to get a 4.5% return on it, which is $700 a week. So in Sydney, 4.5% return would be a dream. Anywhere else in Australia, 4.5% return is usually reasonably okay. It's not mind-blowing, but it's all right. Okay, so that's a sort of standard return, if you like. 4.5 to 5% is like the industry standard that people sort of look for. So I do apologise. I've had a cold, and I might cough every now and then. So $700 a week is what we're looking at in income on an $812,000 property, which is $35,672 a year in rent. Now, one number which is going to be consistent through these 3 examples I want to show you is that if we take that $812,000 as the value, and we say, all right, we want to see in 5 years' time, Anthony, you told us we could make $300,000 in 5 years' time. Well, if we use a growth rate of 7%, which is pretty average, I mean, really 7 to 10% is like what, most capital cities tend to get. And so let's use the average growth rate of 7%. So I'm using that sort of growth rate. And if we say, well, if we project that over the 5-year period, so year 1, 2, 3, and here's year 5, then we've actually turned that property, we've made $307,632 on that property in 5 years. Okay. So as I said to you before, right, the first part of that sentence was, what if you could make $300,000 in 5 years? All right. So if we can all agree that, and you can get your calculator out if you really want to and do it, right? 812 capitalized by 7%. You see it going up here each year, what the values are worth. It's all here. And then in the 5th year, we've made $307,000. Okay, that's great. Now, remember, this is a standard home. This is a standard 4-bedroom home with a rent return of 700, which is 4.5% rent return.
And Anthony, I just did a bit of Googling, but the average house price in Melbourne in February 2023 is $905,000. So this property that you've picked is actually below the average. Just in case anyone was out there thinking that there's a high property price, this one is actually below average in Melbourne, below average in Sydney, and depending elsewhere.
And to be honest, if I was having this discussion with you guys 2 years ago, this price would be, the average price I would have been using would have been low 600s. So the markets in most places in Australia, right? So the most good places. So the average price now, most good places, is 800 now, 2 years later. So anyway, despite that, let's just go with these numbers. This is an average just 4-bedroom house getting basic rent. Now, if I've used two incomes here, one's 130 grand and one's 80 grand. So one party was earning 130 and the other partner was earning 80,000. Okay, so that equals 210. Now I've got some other numbers in here, which, we can go into depth about, but I won't. I'm just going off the basic numbers to show you the concept of what I'm talking about here. Based on a $200,000, $10,000 income, $700 a week, an interest rate of 5.5%, some costs and depreciation, all the other bits and pieces. This property would actually be negatively geared. About in the first year, in year one, would be negatively geared $1,242 a year, or $24 a week. Okay. So in other words, if you would own this property, in year one, it would be costing you $24 a week to own that property. Okay. Now, the word negative to me says it all. Negative, right? You don't want that. It's a negative thing. Don't want it, right? To me,
Definitely don't want negative.
No, you don't need negative. This is the thing. People think that negative gearing, must mean I have to be forking out money out of my pocket every week to do this. You don't need to be, right? But this example just proving my point when you see the other two lots of numbers, that this same property price here is currently costing you $24 a week. Now, I don't like that sort of property, because to me, if the interest rate goes up more again, that price there is going to go up again. You're going to keep having this cost going up when you're trying to pay your mortgage off as it is. Now, I've got some clients that have bought the wrong investment properties, and Gary would probably see this because he does the numbers all the time with them, that might be 150, 200, even $250 a week negatively geared.
We've seen some shocking circumstances when people have bought negatively geared properties, and then something's happened in their workplace, something's happened in their business that has forced them to sell the property prior to that property achieving their potential. And we've seen some devastating effects on that. That's, again, like what Anthony is saying, which is why I always go back to cash flow positive properties, so that when my employment, my job, whatever it may be, doesn't impact my ability to be able to afford to keep that property. And that means that I can sell it whenever I want. I don't have to sell it at the worst possible time in the market. Yeah.
When you own a property, or when you buy an investment property, you really have to think that you're purchasing a small business. That's how you got to think of it, right? You actually, I'm buying a small business. And what is the number one cliche line for small businesses? Cash flow is king. If you buy a small business and you don't have cash flow, you ain't going to last. It's that simple. And Gary will back that up all day long. The amount of companies he's seen, people like little shops, I'll buy a little cafe, I'll buy this thing, I'll buy this business. If it doesn't have cash flow, it just can't survive and weather any storms. It's got no strength there. As soon as something happens in the market, like an interest rate rise, or you lose a tenant for 3 weeks, for example, it causes so much pain. So to me, this situation here is a standard situation a lot of people get themselves into, because they get sometimes emotional about the purchase rather than thinking about the numbers. Okay. So for years, I've been, selling a lot of other people's product. And it's been frustrating, because I've always felt like my hands were tied. I couldn't give the true product I wanted to give. So recently, in the last few years, probably last 5 years, we've come up with our own products, and been able to start, building our own products through different builders around Australia, and designing our own products around the numbers, and really trying to provide people with products that give them stronger numbers. So one of those products that I'll show you, the next lot of numbers, is for a co-living home. Now, for those of you who don't know what co-living is, I've got a frequently asked questions co-living download you can download, and it can go through some info for you. But basically, think of a co-living home as a normal everyday 4-bedroom house and land. It just so happens to have 3 of those bedrooms happen to have en-suites off them. You have 3 lockable pantries in the kitchen, 3 lockable living cupboards in the laundry, and we fully furnish the house. We put 3 separate tenants in there under 3 separate leases, right? So funnily enough, that house I showed you before was the same price, and that would be the example, right? If you were to rent that property out, the same co-living home, you could rent out to just mum and dad and the 2 kids. but that would be the sort of rental income you get. And that could be very problematic. Whereas if we swapped it over and said, well, no, let's make this house so that we're going to rent it out to 3 separate people and get 3 separate incomes, all of a sudden we could be in a position where we've got some locations that can return as much as $1,200 a week on now an $812,000 property. Now, suddenly that becomes $61,000 a year in rent. And on the same income, same interest rates, everything's the same. Remember, the same growth happens here. We're going to get 307,000 in the 5 years based on these numbers. So the growth number hasn't changed, but the income numbers changed dramatically, because basically what we've got now in that first year, we've got $12,900 in positive cash flow. After all expenses and costs are taken out, there's $12,900 coming back into your bank account. Now, that $12,900 could be going anywhere. It could be going to pay off that extra interest payment now you're paying on the mortgage. It could be going to pay off all sorts of other personal debts and other things you've got in your life. And that's an extra $249 a week.
Sorry, one quick thing. And if you look at this one again, you can scroll up to where it has the loan amount. So this is a property that is 100% geared, so 100% lending, no cash required.
That's right.
So to be in an actual positive cash per week position is phenomenal. I just want to point that out to everyone, because again, this is, I think it'd be three of my properties would be this type of situation where, where you helped us find them, we found the right properties, they're cash flow positive from day one of after it's built. We put our strategy has always been to put the after-tax cash flow into the loans and just pay down that loan because it's 100% geared.
Yeah.
But as you say, you can do anything. You can even put it off your home loan, which is non-deductible, so that you keep your deductible loan, which would be the investment property, and you keep that higher. So it just depends on your strategy.
Yeah, that's very true. It's a very important point that we are financing these 100%, where we're using equity from your home in most cases for the deposit and costs. And then we're financing normally 80% over the investment property purchase. There's no mortgage insurance involved. And if you've got enough deposit, it certainly can work very well and very tax effectively. But the key thing here is we've got a product now, and that could have even been the same house as the last example. It's just how we're now using it that changes those numbers dramatically. And because we're in a position now where we're able to create that positive cash flow, it means now we can weather storms. If we were to put that interest rate up to 6.5%, then it will drop that number, but you would still be positively geared and you'd still be able to weather the storm. And this is the biggest point about making sure that cash flow number is strong. The other part about it is too, remember I said before that I could show you how it's possible to make $300,000 over 5 years that cost you nothing to do it. Well, not only is it going to cost you nothing to do it, but you're getting paid to do it. All right? Not only are you getting paid to do it, but now no longer are you making $300,000 over the 5 years. If we add these numbers up, I don't have year 4 here because our program is just showing the longer picture here, but I can certainly guess it'd be about $8,000. So we're talking 12 plus 9, we're already up to 21, 30 plus another 8, 38 plus we're close to 45 or 50 odd grand, whatever the number is in my head, right? We've just made an extra 40 to 50 grand, whatever it is, the number, on top of your 307 over that time. Right? That's pretty phenomenal when you think about it, because this is now, we're making more money than we said we were going to make. And not only is it not costing us, but as I said, we're getting paid to do it. Right? So this is a very key point. These co-living homes are no different to a normal house, really. Very, very minor differences. It's just how we're using it that makes it so much more powerful. And that's what we've been able to design with our builders and all our contacts that we've been working with around Australia to try and find these sort of areas and properties where we can build these sort of products. Because once again, don't get sentimental about the area. You're never going to live in it. The investor's going to live in it. And the key thing about a co-living home is because we've designed it to be such a nice house to live in to rent, we've designed it to be an excellent house for your exit strategy. Okay. Now, before I go to the next slide, I'll just talk about that concept of exit strategy. What if that $300,000 you could pay off your home loan in the next 5 years and it costs you nothing to do it? Would you do it? All right, it'd be a pretty easy decision, wouldn't it? Because I mean, at the end of the day, you're buying a property and saying, well, hang on, it's not costing me anything to do it. I'm getting great cash flow while I'm doing it. If I can make $300,000 in the next 5 years, I sell the property, ignoring capital gains tax for now. Just that's a Gary problem.
No, that is a Gary problem.
Yeah. So, but ignoring that for now, if you took that 300, and let's say you had a $900,000 home loan, right, which people these days have. I mean, the average is like $700,000 now. Right. So if you had a $900,000 home loan, you paid $300,000 off that home loan, you've now got $600,000. Okay. Now, because you've paid $300,000 off, there's a good chance if the numbers are right, the bank's going to lend you enough money to go and buy 2 properties this time. So in the next 5 years, you could have 2 properties, which you're going to make $300,000 on each, which means we can sell those in the 10-year mark, and we can have your entire $900,000 home loan paid off in 10 years. It's possible to do, right? Because this is just numbers. If we buy in the right areas that get the growth, that have infrastructure, government spending, population growth in those areas in strong levels, and we've got opportunity to then be able to pay those homes off quickly, then 10 years has cost you nothing to pay your home loan off if you have the right cash flow numbers. Right? So that's why it's so important to get the cash flow right, because if we can do that, we can afford to hold it for the longer period that we want to get that growth to be able to then sell the property and pay those debts off. Right? So it's a very powerful way of getting rid of your financial cancer, as I talked about before. Right? Because as far as I'm concerned, that's got to go. Before we talk about retirement planning, sort your now out. Right? You don't want to plan a world holiday to go away for 6 months if you've just been diagnosed with a terminal illness. You'd rather sort the terminal illness out first before you go on your holiday, right? And that's what we're going to do.
Sorry to cut you off. I just got a couple of questions here, so I thought I would share it with everyone.
Yeah.
When we're talking about renting out the rooms, and again, I have several properties that we do this, and we've purchased a couple more that we're also doing this. The difficulty is actually, for me as an investor, is I do jack all. I just get my real estate agent, get you guys. You're the ones who actually go out, find the tenants, fill in the paperwork, get the bonds, do all that fun stuff that I have no interest in. And I just sit back and the money comes in my bank account. So that's part one. Part two, another question that was asked, it's just a private message, but another question that was asked is, and I'll let you explain this one, Anthony, but how could we have more than 100% gearing on a property or 100% gearing on a property? So more all around that number. How do we do that?
It's a good question. I mean, if you were to go and buy your first investment property or your first home, the bank requires you to have a deposit, right? So they want you to come up with something before, so they won't give you 100%, right? But because you've got equity in your home, so let's say, for example, you have a home worth 1.2 million, you owe 600,000 on it. Okay, you've got $600,000 equity in there, but effectively you've got up to 80% of the value of that property is available equity. So you've got easily $200,000 available there, which to go and buy a property worth $800,000, if we needed a 20% deposit plus costs, we can take that equity from the home and park it on that side, and then we go and get the 80% loan over the investment property. So basically you can split it up so that you're not cross-collateralizing the 2 properties, because that's a very dangerous thing to do, because the banks love to do that. They'll do that all day long because they'll lock you in. They'll say, oh, you've got all this equity, we'll just give you 100% of the value of the property. No, they won't. They'll secure the property to your house, and that's a very dangerous thing to do. So instead of doing that, we like to split it up and say, let's use 20% plus costs over your home, and then use the 80% over the investment property. And that's why we end up with over 100% in borrowings all up. But as Gary can explain to you, it doesn't matter where it sits, it's all tax deductible, the interest on those loans, because the money spread out between the 2 properties is used for an investment purpose.
Correct. So as long as we're using the nexus, as long as we borrow money for the purpose of investment property, shares, sometimes business, whatever the form of investment is, then regardless of if we've used our home loan, our personal home loan, regardless of the method of borrowing the money, that would all become a tax deduction.
Yeah. Good questions. Keep them coming. Happy to answer them as best I can. The next example I want to show you is another style of property that we do as well. Once again, using the same numbers. So I haven't changed the numbers in the sense of the purchase price. I haven't changed the numbers in the sense of growth or the interest rate, but I've changed the numbers in the sense of income. So another a sector of property that we're focusing on is NDIS SDA properties. So once again, I have a frequently asked questions booklet, which I can send you, which has got lots of answers in there for many questions people have. But in short, it's the government has rolled out the NDIS back in 2016 to look after people with disabilities in Australia. There's about 14% of the Australian population that's on the NDIS, so that's 3.5 million people. And we all fund it, where they put a Medicare levy in, 0.25% increase on the Medicare levy, so that would cover it, which is about $28 billion a year that comes from that. And that money goes back into funding all forms of people with disabilities. But one sector that we're focused on is what's called SDA, which is specialist disability accommodation. So for people who have extreme disability needs and who really can't work anymore, and they can't have an opportunity to, own their own home, then they can qualify for specialist disability accommodation under the NDIS. Now, as part of that, that's the participant, that's the person. Then the second part is that there's 4 different levels of houses that can be built. So we build SDA homes that are SDA approved for an SDA participant to live in. Now, because the government is spending so much money on housing people with disabilities in hospitals, in all sorts of different care arrangements, and even some people are being housed in, a lot of people are being housed in nursing homes, which is very sad, and also a lot of people are being housed in prisons, funnily enough. They're trying to encourage everyday Australian investors to go out and invest into this sector and to spend their investment money on purchasing properties that are specifically designed for people with disability needs at the 4 different levels. So the idea is that because they want to encourage investors to do it, they are paying pretty strong rental income. Now, that rental income can vary around Australia depending on the location, depending on the level of disability the participant has. So there's a number of different reasons why those income levels can change. But I'm using the example here that we actually, we have available to us. And I'll show you the numbers on this one because the numbers on this can be quite impressive. So basically I've used the same price again, 812. And this property is same again, 7% growth rate, same sort of increase in value over the time based on that. But if we look at the income, these are certainly a more income driven type property. So for one of these SDA type homes, you can be looking up to $1,600 a week in rent for an $812,000 home. So that's like a 12% return on rental return. It's very good return. It doesn't come without its challenges. Okay, anything government backed or government orientated, believe me, we run the management business that looks after these participants and their housing. We're an NDIS authorised service provider, and I hear my girls working all day, very, very hard, with all the different people that are involved in putting participants in homes, and it can be very, very time consuming, and it can be very, very painful. And there's some seriously, needy people out there who really need this sort of product and need this sort of level of care. But it's very rewarding. Okay, so I mean, we do it because the end goal is that we get to house people with disabilities that are being held and placed in totally unacceptable circumstances of care at the moment. So we do love what we do, but it's extremely draining from a process of the NDIS, as I said, can be a little clunky. It's getting better, and over time we'll get better. It's a 20-year scheme, so let's hope by year 19 they've got it figured out. But the main thing is that we've got a pretty good grasp on getting tenants. We've got a pretty good grasp on what we need to be building and where we need to be building it and what level we need to be building it at. That's the most important thing. A lot of people and builders are building this product. They're doing it in the wrong levels, the wrong areas. They've got no idea what they're doing. They're not managing it. They don't know how to manage it. They don't really care. As long as the numbers look good on paper, they'll just sell it to people. But these numbers are pretty factual. This is the new stuff we've got coming on, the new designs we've brought out now, some of the numbers for it. And when you look at the cash flow on this, as I said before, the numbers are the same, income numbers are the same, everything's the same. But you're talking about, for example, on this sort of after-tax cash flow here is $22,000 a year, which is, over $400 a week positively cash flowed.
And again, if you look at that one, and this is again with zero deposits, we're using 100% leverage. So
yeah,
the craziness on these, and again, I have 3 of these, like the exact NDIS properties. I have 3 of them in Queensland, and they're phenomenal in this context, definitely phenomenal. And again, I won't mention other names on here for privacy reasons, but there is a couple other people in here that have them as well. As far as I'm aware, they're quite happy.
The key in this is, remember before we were talking about, like, how can you make $300,000 over 5 years and cost you nothing to do it? Well, if we look at these numbers here, adding in the 4th year in the middle, we're actually making over $100,000 in cash flow over those 5 years. If it's fully tenanted at this rate, that's an extra 100 grand. So effectively, we've made $400,000 in 5 years, and you've been $20,000 a year positive cash flow while doing it. Right, so it's a very powerful product. It's not for everybody. I'll tell you that straight up. Okay, some people can't afford to do it because the numbers on this are hard. Valuations are painful with this. The banks do not understand the product, and we have a lot of pushback. We've got some lenders that can help us and do guide us and are very good, but as I said, it doesn't suit everybody. And then some people, they just can't get their heads around it. Like it becomes too, as I say to people, if you can't sleep at night knowing all the good, the bad, and the ugly, it's not for you. Go with a co-living home. Far more suitable.
And I'll just add a little bit more onto that one because Daniel's asked the question. Look, the biggest challenge that I've had with the NDIS product is, for me, all it was is you do the build, you get a tenant, you get paid rent. So I look at it again as a big picture, but if you're really tight on cash flow, then it's probably not going to be the right product for you. You might have, I mean, we were one of your first clients.
Yeah.
With NDIS.
You're one of our guinea pigs.
One of the guinea pigs. So it's been a couple of years, right? It's been like 2-3 years, maybe.
Well, since it's been finished, yeah.
So let's say there might be 1-2 bad years out of 20 years.
Yeah.
The question is, if you're in the financial position where you can afford that at the start, in the middle, at the end, you've just got to know in the back of your mind, just like commercial properties, is that it may not go right, but it's only going to be 1 year, 2 years out of 20.
Yeah.
And for me, I can sleep fine at night knowing that. And we've not had any fundamental problems in whatever 2 or 3 years. It's all worked out pretty well. And the house prices have gone up too, which is an added bonus.
Yeah, and I won't say, I'm not going to gloss it up. Okay, I'm not going to tell you all the good things, because I'm not going to say that Gary's situation is how it's going to be for everybody. There are some challenges in this space because you're working with people with disabilities. I mean, you can have people have behavioural issues. You can have people that, and we had a client die recently, and that happens because these people's disabilities usually aren't getting any better, and it can be quite, quite hard to deal with the NDIS on basic needs and situations, but that's our job. That's why you pay us to manage the property to work with that. But at the same time, as Gary said, it's not for everybody, because you need to be able to float the bad times with the good times, and you need to be able to have that buffer. But it's really good product for people who are, I suppose, have got the equity in their property. For older people who may be looking at a good, income, as a retirement income and a good cash flow for retirement. It can certainly be good for people who have a super fund, who might want to, get some good sort of cash flow into the super fund, and obviously the lower tax rates, it can be very helpful. Gary suggests, obviously, with any of the properties we look at, you need to be talking to him about the ownership side of whether you should be owning them in a trust or your own name. But certainly with NDIS properties, from what we've seen so far, most people buy them in a trust because the cash flow The tax benefits of that are massive. So, you know, we need to look at things like that. So there's a bit of complexity in the product. And as I said, it doesn't suit everybody. But, you know, certainly we can do the litmus test and we can see if it's something that works for you. If it doesn't, that's okay. You can look at a co-living product, which has still got very good income, it's still got very good growth, but probably just might be easier to deal with from a day-to-day basis. So in summary, as I said, I've given you the 3 property examples at the same price. I've shown you that it is possible to make $300,000 in 5 years, and it is possible to do it, to cost you nothing to do it. And it is actually even possible to be paid to do it if you set the right income up. But it's really got to do with that income. Because if we go back to that first example, you know, we were $24 a week negatively geared on that example, exactly the same price point, basically exactly the same home as what a co-living would be, which is going to be $249 a week positively geared. So it's all about how you structure it and how you set it up. And this is where having people like us who have gone through this for many years, and I've looked for solutions to help people, you know, get ahead. This is why it's so important, rather than going to a real estate agent who is just going to sell you something like that and tell you it's wonderful, right? It really comes down to these cash flow numbers. Cash flow is king, and you'll be able to keep it as long as you do that. So I've got a case study here, which I'll quickly go through. Just a client we had, they had 130 income at 80 in income for Amy. Home value was 1.2, mortgage was 450. You know, investing in property had been a long-term goal for them to help secure their financial future and minimise their tax. An increase in their mortgage repayments had them fearing it was no longer possible to purchase investment property. Definitely could not afford to purchase a property if it was negatively geared, because there's no way that they could run the cash flow. The strategy really was to source a cash flow positive property solution, consolidate their other debts, improving their monthly cash flow, maximise tax benefits for them both, especially for Alex, through negative gearing aspects of the property purchase. So that was the ultimate goal for them. This was the purchase that they used. That's why I've used that example tonight, because there was an $812,000 purchase with an estimated weekly income of $1,200 per week. Obviously, that's a 7.68% you know, gross yield, which is great. 4-bedroom house, 4 bathroom, 2 cars. So it was a co-living style home, and the numbers worked for them. You know, it really did. They had a good solution, as I showed you before. That was their numbers, right? So the cash flow really was something that they needed to make some inroads on their mortgage, and to keep themselves their head above water. As interest rates have been going up, it's going to certainly make a big difference to their cash flow and their lifestyle. So, you know, we've got the group of companies, as I said. We've got the finance side of the business, which looks after people's finance and their purchase. We've got the management side of the businesses. We've even got a lifetime rental income guarantee, which basically, you know, we run that ourselves. We don't incorporate that into the price. If you want that and you can't sleep at night because you're worried you're not going to get a tenant, we can talk about it. It's not there for everybody to be used. It's just there for those people who are really nervous about getting a tenant. If they really want to look at it, they can look at it. We just provide that as more of a courtesy service than we do a money-making object of any sort of sort. It's just for people who can't sleep at night. And then, you know, with our Save Your Finance business, we actually donate, for every $100,000 you borrow, we donate $100 to the charity of your choice on your behalf. So if you have a loan that we end up refinancing and we purchase a new property, it ends up being, you know, $1.4 million worth of finance, for example, we'll donate $1,400 to the charity of your choice. Right. So we've got our own charity as well we support, which is Destiny Rescue, which is a great charity. And if you don't have one that you regularly support, there's certainly great reasons why to support ours. But if you do have one, then, and if you're going to get a loan anyway, then CBA will just announce their $5 billion profit for the quarter. If you go through them, if you go through a broker who's going to give you a CBA loan, he'll make all the money and put it in his pocket. If you go through us, we'll go through CBA as well, but you can donate to your favourite charity. So there's no catch. It's just, we'll do the loan instead and donate to your favourite charity. So even if you're looking to refinance or anything, we can help you. Right. So just, it means that we can also help the charity. Right. So it's part of our giving back program we do as a business. So I guess, you know, in summary, what's your number one purpose? What is your number one why? You know, why are you here tonight? You know, what do you want to achieve by looking at investing? We believe we can help you go through that and unwrap that and unpack that and try and figure out what a great solution we can do for you to achieve your goals and achieve your why. So thanks for having me, guys, and I hope you got something out of tonight. If you've got any more questions, feel free to ask. Happy to answer any questions. So.
And thanks, thanks, Anthony, for sharing that with us all. Going on to this Heath's question while we're here. Yeah, there is, I've seen big complex, like, you know, three units or something, where they would have an SDA property down the bottom, and then they'd have co-living on different bedrooms and stuff, different units in the complex. Normally they're like 2 or 3 bedrooms per unit, because it's still got to be a feasible one. It actually just came across one over the weekend up in Darwin, no, sorry, up in Brisbane. I think it was 3.5 million. But it's a great question. Now, our next speaker may be running a couple minutes late. Hopefully he does turn up, because he is on US time zone at the moment. I think AB Andrew is he's visiting his family at the moment, so I'm just waiting for him to tell me he's good to go. But does anyone have any other questions regarding property while we do have Anthony here to talk about any other random types of questions? If you want to challenge me on anything that I said last week about properties or about shares, we can open that up at the moment. Generally speaking, the interest rates that we're seeing at the moment are that 5, 6, and 7%. So keep that in mind. And when you are doing a build, the interest that you calculate on a build is going to be a lot lower than the total loan amount, because you don't draw the full amount at the start. You definitely progress paying while you're doing the build there. And I think here, again, looking at everyone around here, you know, the old mentality of waiting until you pay off your first family home before you do an investment property. I see that quite often. And I think about that and going, well, if I stuck with that model, I probably would have cost myself a couple $1 million over the last 10 years. So for me, I always go quite, I'm quite a risk taker. So I like to go pretty hard into property. Even right now, we're expanding our property portfolio. We're growing that, but I also think that you got to buy the right properties at the right times, and you've got to make sure you make an informed decision. So using that rubric that I showed everyone last week, if you don't have it, it will be getting sent out to you, but using that rubric to compare different investment properties and weigh up different options so that you know you're making the right informed decisions without the emotional side of things. Because if you had the pleasure of dealing with me on a one-on-one basis, you'll know that I like to remove the emotion. I'm a bit blunt on some of my advice and emotions towards buying investments. Russell, you've asked the question for SDA, are you seeing increased build costs? Does the capital value appreciate the same rate since they start off higher? I'll answer this first, in my opinion, and what I've experienced on my properties, and then Anthony, you can share us with the latest of those, because I haven't bought in a couple of years. So build costs, I find, are, you know, they are built to a better standard. For me, one of the properties that I have in, I'm going to probably butcher the name of this place. Anthony, you want to save me a little bit?
Where is it?
Is Coomera? Was it Coomera? What's it called?
Yeah, Coomera.
Coomera. Yes, one of the properties I have in Coomera, I walked into it and it has, you know, big doorways, big kitchen. I go into the kitchen, it has a butler's pantry. And what's really cool, because it's wheelchair friendly, you can spin a wheelchair around in the kitchen and the butler's pantry. And I thought to myself, this is a really nice property. And I went back to Melbourne and I bought a new place. So the quality of builds are done to a certain standard that I thought is quite high. And obviously that's going to cost more than a normal build, especially if you're doing a cheap build from an investment perspective. But from a capital appreciation, I can't see there being a negative with me having a bigger kitchen, bigger lounge rooms, bigger doorways, bigger bathrooms. I just don't see that as being a negative. And I think that will show at some point in 10 years time when I sell the property. I think that will show then in the capital appreciation. What's your take on that, Anthony?
Yeah, I agree. I think that you've got to look at the long term. STA build costs are dearer. If you look at the per square meter rate, I think the average build is like $3,500 a square meter for robust, which is one of the levels that we build. And we're well under that. So I think that from a level, it's really tricky because, when you say, it's like when you say the word wedding, when you're booking a function, right? As soon as you mention the word wedding, price goes up. It's the same thing with this. You mention the word disability, price goes up. All the suppliers charge you extra money, disability tax, basically. Oh, you need that special toilet. Oh, you need that special sink. There is compliance we have to adhere to, and some of those items are just expensive because they're compliant items. And generally build costs have gone up, horrendously in the last 18 months. Okay. So much so that some areas are so out of whack with the new price of the house build versus what the old price of the house is selling for. It's incredible. I just don't think the old prices of houses have caught up yet and realized what it costs to build a new one yet. And the real estate agents in some of those areas are not realizing that those houses should be more, because to build a brand new one would be just, $150,000 to $200,000 more. I think that there's not much you can do to avoid it, because no matter where we go, it doesn't matter where we go location-wise and builder-wise, we're facing the same problem. So unless they're really amazingly colluding together, I don't believe they are. I just believe it's supply chain cost that's increased the price. And it's painful, but it's one that we've just got to look at. And look, we're doing the numbers and return based on what you're paying for it today. So at the end of the day, that return, in essence, is only going to get better because as time goes on, the NDIS funding does increase. Your purchase price doesn't increase. So your return, in essence, will get more and more over the time and get better and better. So one of the questions too I saw on there was about our ebook. If anyone wants to download it, you can go to our website, which is propertyinvestmentstore.com.au. And you can click on the side there and it's download ebook. So you can go on there and download it. It's worth a read. I mean, it gives you that concept of really how to get rid of that financial cancer of your mortgage and how to go over that a bit more in more detail. And it just shows you the concept that we're talking about, which if you've got a mortgage, just read it. I mean, even if you decide not to do anything and keep your cancer, it's up to you. But we want to show you how to get rid of it, and we believe we can. So what other questions do we have there, Gary, that might be worth looking at?
So I guess one of the repeat questions has been, how do we pick a location to build a property or one of these properties in? How are we doing that?
Depends on the property. So co-living and NDIS are very different properties, like the type of properties they are. Co-living is a product that tends to be very well suited to regional areas or more outlying of the city areas. A lot of the areas we're building co-living in, they haven't seen this product. It's something that when we turn up, they sort of go, oh, wow, like it's something they need, because the areas we're targeting we want to see people, with jobs that might be on 12-month contracts. It's executive style living. This is not, student frat house stuff. Okay. This is like trying to get people in who are going to pay good rent, and they're going to be you think about it. If you're moving to an area and you're on contract for 12 months and you're going to pay you know, might pay $700 a week to live in a house in that area. You have to go and buy all your own furniture, have to go pay all your own, you know, full bond and everything. It gets expensive. And then when you leave in 12 months' time, what are you going to do with all the furniture? And it's painful. With a co-living property, you can move in, and you know, you're in a position where from day one you've got furniture in the house, you've moved into a brand new home, you've got your electricity, your water, your internet all covered in that costing, which was all in those numbers. It's all costed in there, and you might only pay $400 a week.
And what I might do there is give an example, because Daniel, you asked me earlier if we can find tenants. So Anthony, did you just pick a suburb for me? Any suburb?
A suburb of what?
Yep.
To find tenants for co-living?
Yeah, or just to build. Yeah, where would we just pick a suburb, even something in New South Wales, Queensland, Victoria? Just
one we're building in, or one you'd consider building in?
Yeah.
Oh well, I mean, one for example that we're doing something at the moment is Darwin, Northern Territory.
Do you want to give me the exact suburb of Darwin?
Yeah.
I can't do Darwin.
You can do, let's say, Farrar, Farrar, Northern Territory. There it is.
Not something that we've pre-set up, but let's have a look. There you go. So going back to the point of showing this, so one of my favorite websites, we have 9 houses available for rent in the last 30 days, and we had 205 people that were interested in renting the place. So anyone has any doubts about finding tenants for a co-living house, like not an NDIS one, just co-living, jump on this website, check out that suburb, and you can see why the co-living product will work.
The other reason why we're there is because 51% of the population in Darwin are single, between 25 and 45 years of age. That's our target market.
Are we going to have a conference up there soon or something?
I'm hoping so. But, you know, I hadn't been to Darwin in all these years, and hadn't even thought about Darwin, you know, as being an opportunity. But when I went there and spent 5 days there doing my research, there's so much going on there. I mean, there's infrastructure, government spending, population growth. They're paying people to move there. They'll pay you removals costs to move up there. You know, there's billions of dollars being spent in all different sectors up there. So to me, and it hasn't really seen much growth since 2015. So the rest of Australia's gone bananas, and Darwin's just sat there doing nothing. Yet up there now at auction, they're still paying 200, 250 over and above the purchase price on properties. So that's not happening anywhere else in Australia right now. Like, everything's gone dead. Barely an auction. Everyone's going back to selling because they're scared of auctions now, because the close rates are terrible. You know, a lot of other places. So to me, we're targeting areas that had opportunity for getting a tenant based on that infrastructure, government spending, population model. This is for co-living. When it comes to NDIS, totally different discussion, okay? Because NDIS is about, you're never going to be able to go to realestate.com and type in where people with disabilities that have SDA approval are, that can actually, you know, find one of these homes. We can't even do that with the NDIS website. So there's no magic list with this. It's all one of those cases of, well, you've got to do your best to talk to the people, have relationships in the area, and discuss with them what their needs are and try and build to the needs, you know, rather than just sort of guessing and just plonking a house in there and hoping you're going to get a tenant, because that's not the way you do it in the NDIS space. So you've got 2 very different types of products and 2 very different types of structures in how they operate. So, you know, and we do our research. Everything we do is based on, as I said, we've got the property management business on co-living and for NDIS. If we don't get you a tenant, if we build in an area that's not going to get tenants, we don't get any earning income from not finding you a tenant. So it's in our best interest to make sure we do our best to find you a tenant. Otherwise, our businesses don't make any money. So we've got skin in the game with you guys as investors, and we want that to be a real key part of what we do, and be accountable for making sure we can get you a tenant, because we are building these homes in a good area.
And Daniel asks us another question about rent vesting. What your thoughts on it? And to start off with, I believe I owned 5 houses or 5 investment properties before I owned one to live in. So for me, it was all about making as much wealth as possible prior to buying something that I lived in. And I was quite happy with that decision that I've made. And looking back on it, I did quite well out of rent vesting. That's my opinion and how it worked for me. But what are your thoughts on rent vesting, Anthony?
I think if we were to poll most most homeowners here that have a mortgage and have had a mortgage for a long time, if they were to live their life again, they would definitely consider investing. I think because the idea of rent where you want to live and buy where you can make money, what's wrong with that idea? You know, at the end of the day, why get yourself into a whole bunch of financial cancer to spend all your life trying to pay it off by yourself? Because if you go and get into debt and buying your own home, there's a good chance you're going to be right up to the eyeballs with your borrowing capacity, which means you're not going to be in a position to be able to go and buy an investment property to help you pay that loan off. So until you can sit back and wait for that property to go up in value, which may take who knows how many years, you're not going to have enough equity. Secondly, unless you've got a massive pay rise at work, you're probably not going to have enough income either to go and get a property to help pay that mortgage off. So to me, rent vesting is what should be being taught at school, not Pythagoras' theorem. I don't know how many people have used that today, but I haven't used that much today. But at the end of the day, when it comes down to it, I guarantee everyone's been worried about their debts and on their bills and all these sort of things today. And this is not what we get taught at school. Right? We don't get taught the basic economics of getting a home loan and being in debt forevermore. And why do you think banks are announcing $5 billion profits for a quarter? One bank.
They've got some crazy profits at the moment. The bank side of things, that the margins that they're making are quite high.
And there's 200,000 people coming out, I believe, over the next month of fixed rate loans.
Yep.
How are they going to go when they're rate? Okay, let's just do a quick sum, right? Let's say the average debt is $700,000 in Australia, like on average mortgage these days, right? And let's say you're on 1.8%, okay, which some of these people were fixed rate 1.8%. That's $12,600 a year. Divide that by 52. That's $240 a week they were paying to live in their house. They were paying rent of $240 a week. No wonder no one cared. They were complacent. Like, how good's that? $240 a week. I live in a nice house. Great. That's all wonderful, right? So now when they come out of their fixed rate into the 5.5% world, it's now $38,500 a year. Divide that by 52. That's $740 a week in their mortgage, in their rent now. Okay, so their rent's suddenly gone up $500 a week. Now, suddenly that's after tax money, mind you, and that's only an interest only number I'm working on. They're not working on principal interest. So realistically, those people are in a world of pain. And it's only now they're realizing, oh, I probably need to do something about this mortgage.
I think you'll find as that keeps happening closer to September, that's my pick. My pick is September is when we have a rate drop. But again, you can't rely on it. And this is why I look at those investment properties with those high yielding properties, ones that are having that 7-8% yield, rental yields. That's where you got your rental income divided by the purchase price of the property. And we're looking at that 7-8%. So we can ride through any of these, interest rate increase storms.
Remember, there's no really a bad time to be an investor, right? Because there's a bad time to be a homeowner. So if rates are going up, it's like those people, it's painful. It's hurting your pocket. That's after-tax money you've had to earn to pay that bill right now. But there's no real bad time to be an investor. When rates go up, rents go up. If rates go up, it means less people can buy their own home, which means more people have to rent, which means more pressures on the rental market, which means rent go up. So if you're an investor right now, you're sitting back just going, how good's this? With rates going up, it's all relative for me because rents are going up.
Yeah, absolutely. And we're seeing that across the board. Every single suburb that I've looked at has rental increases, which is great for investors and not so great for people that are renting, that can't afford that cost of living increase.
Yeah. And I had a client the other day whose rent went up $140 a week just in a basic little 2-bedroom unit. One jump. Now, what are they going to do? Oh, I'm going to move out. Okay, where are you going to move to? You're going to move to a place that's going to be that $140 a week dearer anyway. So they've got no choice but to pay it.
Might as well. Absolutely. So we believe our second guest speaker is fast asleep on California time. It is around that 2 a.m. and I believe that someone may or may not have forgotten to remind him that he was speaking today. I don't know if that falls on my shoulders or someone else's shoulders. I'm not quite sure, but we only have the amazing Anthony Soole with us tonight. So I appreciate everyone for tuning in, sticking around, and enjoying this. We will obviously send this out on record. If anyone has any questions on property, if you email them to me, I will forward them across to Anthony to respond. Next month, we will be doing marketing and sales for small business. So please stick around for next month. It's going to be really exciting. We do have another guest speaker who will be reminded to turn up and will not be sleeping. And I look forward to sharing with you that special topic next month. As always, if any questions, reach out to me, and thank you for joining in.
Thanks, guys.